to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. We got, as always, very important things to know. We had a short week investment-wise when the markets closed on Friday, but we're still going to talk about the numbers for the jobs report. Came in on Thursday, as it would normally on Friday, but the jobs number looks stronger than it really was. We'll talk about that, or really is, not was. Got to talk about this one too, Chase. So why did Apple produce the new movie F1? I think I'm going to like the movie. Haven't seen it yet, but I don't understand it. We'll discuss that. And very important for people, please don't be fooled by these ultra-high income ETFs. Too many people are falling for these. We'll talk about how to look out for them and to be careful and what they are so you don't fall for them.
Yeah, no, excited to especially cover that last one. I think it is one people need to be very careful of. But as always, companies we're going to take a look at in the back part of the show. We're going to look at Goldman Sachs, Robinhood, health insurance company Centene. I mean, they got pummeled this last week. Curious if maybe that presents a buying opportunity. And then also we saw that trade deal with Vietnam. We're going to look at one of the most exposed companies to Vietnam, and that's Columbia Sportswear. So excited to look at those four companies, give you the fundamentals, give you our opinion if we think it's buy, sell, or hold, based off the numbers we see here on air.
Hey, Columbia Sportswear, I know it's a symbol. Looks like calm with an O.
Calm with an O, yeah. Will it keep you calm?
Well,
I don't know.
Well, yeah, so I was wondering, are they comfortable to keep you calm? So, hey, we got some great news coming up for people to promote the live Smart Investing Show. You're invited to be part of the show. We're going to do a live taping. The Smart Investing Show on July 25th at 3 p.m. They'll be here at our in-office studio. It is free, but space is very limited in our studio. But if you want to do that, RSVP on smartinvesting2000.com. Again, that's smartinvesting2000.com. Look for the podcast tab, and you can sign up right there for it. You'll be part of the audience, and you'll get your chance to ask your investing, economic, stock, and financial planning questions at the show, because the show will probably go 3 to 4, and then from 4 to 5, we'll talk about things people want to talk about in our studio audience here.
Yeah, no, it's going to be exciting.
Cool. All right, well, let's talk about, you want to talk about Apple's movie first? Is that what we said we'd talk about first? No.
I thought we were jumping into jobs.
Oh, we did say jobs. I got my papers all mixed up here. Here they are. Okay, sorry about that. Yeah, we're going to do the jobs first because, well, the headline number, and this was a surprise, showed an addition of 147,000 jobs in the month of June. Now, that was well above the estimate of 110,000 jobs and follows upward revisions. And these are always important for the months of April and May. Total additional 16,000 jobs. This is amazing when I saw this report.
Yeah, I mean, I'm going to take the other side of the coin. I'm going to say it's amazing that it came in above expectation, but the problem is when you dive into this report, and it's kind of funny, last month it's like the jobs report was stronger than the headlines kind of showed. This month, I'm going to say the jobs report was not as strong as the headline showed. And the big reason for that is government actually accounted for 73,000 of those new jobs in the month of June. And I want to be clear, I don't think this is a bad jobs report. I just don't think it's as strong as the headline number because, again, government was essentially half of the jobs that were created in the month of June. And it didn't come from federal government. Federal government actually lost 7,000 jobs in the month, and we're still waiting to see, again, those Doge layoffs that took place. Seems like those are kind of starting to percolate through the economy. I think those will really ramp up in the coming months. But it was instead state and local government, which added a combined 80,000 jobs in the month of June. Most of that came from education. When I was listening to CNBC, they were saying it seems a lot of that was really due to seasonal adjustments. Kind of like I'm going to say it was a quirky little thing that occurred. It wasn't like, there was all these jobs created. It was just these seasonal adjustments that impacted the report. And I got to be clear here. That's not going to happen going forward. Those state and local jobs that were created from the government, that's not going to happen again in August, September, October. So it really, I'm going to say, wasn't maybe as strong as the headline showed again.
And I got a question. And one thing, too. Whenever we think of government jobs, everybody thinks federal government. Yeah. But there is state and local. But again, you said the educational part. And I'm thinking, this is the June report.
Yeah.
don't kids get out of school in June? So wouldn't it be the reverse? Would it be people would be taking off for the summer. I don't see how they created 80,000 jobs.
And that's where you got to look at, again, it's seasonally adjusted. So it's not like an absolute number. Right. There's adjustments that take place. So this June number could have had a sway based off maybe what happened last June, and it really kind of changed the actual numbers for the report, which, you always kind of take numbers with a grain of salt. And I'm definitely taking this report with a grain of salt, to say the least.
And again, the headline number looks good, but you got to put question marks behind there because, again, I still don't understand this 80,000 jobs created in most of education. I still don't get that season adjusted or not. I don't see what the season is. I mean, I'm just not getting it. But I'll say it's a good report. And also, too, other areas that were strong did include healthcare and social assistance. They added 58,600 jobs. Leisure and hospitality, they were up 20,000, and construction, this is a good one, was up 15,000. So some good numbers there.
Yeah, I would say especially the last two were quite positive because leisure and hospitality, I mean, again, you're not going to be adding jobs unless you're thinking you're going to get more customers in the door, essentially. And it's kind of funny, Sarah Eisen from CNBC, I hadn't heard this before, but she said, not government, healthcare and social assistance. She said it's kind of government adjacent is what she had kind of called it. And I was like, that's an interesting way to put it because it's not necessarily a true indicator, I guess, of the health of the private sector. So, I mean, they were kind of, I'm going to say, bashing this report a little bit more because, again, it was government and government adjacent from the healthcare and the social assistance as well. But the other thing that concerned me was many of the other areas in the report was, I'm going to say, quite muted. And actually, there were losses of 7,000 jobs in manufacturing and 7,000 jobs in professional and business services as well. So we've been seeing this broad-based strength for many, many months, and now you're kind of starting to see maybe things are softening a little bit in different areas of the economy.
And again, we are starting the summer season, so people do kind of take things a little bit easier during that time frame.
And it's just 1 month.
It's just 1 month. And
numbers change all the time.
That's why we do this every month for our listeners and our viewers, so that they can hear every month what we're talking about. Because again, it's not like, make decisions based on that. Make decisions based on what we say, and we look at these every single month. A lot of data we look at when we manage our $700 million plus portfolio. But also, too, I did notice the unemployment rate. Well, it ticked down to 4.1%. And that was the lowest level since February and came in below the expectation of 4.3. So again, another positive there. Now, largely due to the decline in the labor participation rate, which drops to 62.3%. That was the lowest level since 2022. Now, working age population continues to shrink while the retirement population continues to grow. In fact, the prime working age participation rate was actually near a record high of 83. There was more positive news on the inflation front as the average hourly earnings saw a manageable year-over-year increase of 3.7%.
And I think that wage inflation around, again, 3.5% to even 4%, I think is healthy. I think it's not going to, derive too much of an inflation concern. You have to remember back in 2022 when inflation was kind of a little bit more problematic, wage inflation was almost 6%. I mean, that was hard on the inflation picture. And, we talk about this a lot, but it's good that home prices have gone up. It's good that stock prices have gone on up. But from the downside, it's enabled a lot of people to retire. And that's good. That's good. I love people retiring. It's good for them. They deserve it. But the problem is you're removing workers from the workforce. We definitely have an issue, I think, with growth going forward. We might have an issue because we don't have enough prime age workers in the country. I don't know how we can keep growing jobs at 150, 200,000 a month if we don't have the capacity of prime age workers. That's going to be a big issue, I think, as we move forward here.
Go ahead.
I was going to say, too, I don't know if you had anything else on that point, but I was going to jump to the JOLTs report here next, too.
Yeah, let's do the JOLTs.
Yeah, JOLTs report, I mean, again, another strong economic data that we saw here with job openings. They actually rose 374,000 in the month of May to 7.769 million. This easily topped the estimate of 7.3 million. But again, back to my prior point, do we have enough people to fulfill those jobs is the big question.
And I think that will come in future years from automation. Legal immigration is going to be happening more. Again, we're not against immigration, but it has to be legal immigration. So I think that will have to fill up because the younger people today just not having enough babies, and that happened actually probably 20 years ago. Now we're kind of suffering.
I'm trying to do my part.
You are. Priscilla and Sarah. Well, Priscilla's got one. Sarah, come on, get busy. Let's talk about the jobs report because layoffs did decline 188,000 to 1.601 million jobs. while this was a positive for the economy and shows the labor market remains very strong, it does hurt the chances of that July rate cut everybody's hoping for from the Federal Reserve in July. Fed Chair Powell during a panel said, in effect, we went on hold when we saw the size of the tariffs, and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. I see the case for a July cut, but I believe it'd be more likely probably in a couple months in September. I just don't think it's going to happen in July. And I wish Trump would be more talking with Powell as opposed to bashing him, because
parading him. Yeah, I think he said on Wednesday or something like, resign. I think it's time for Powell to resign or something. I was like, oh.
But if he says, like, I know you're concerned about the tariffs, but I've got a plan and the plan's going to work. Just be patient. Cut rates. If it doesn't work, you can raise them again. Yeah. But it's just we keep waiting, and the economy's not in bad shape.
No, and I think it's interesting. I mean, after the jobs report on Thursday, the chances for a July cut, I think, dropped to like 5%. They were only like 20%, so it wasn't very high odds anyways. I mean, you have gotten a couple Fed members that were kind of on board with potentially cutting rates in July, so it'll be interesting to see if there is a little bit of dissent from, the group that wants to keep rates steady. But I think it's interesting that the jobs numbers, I don't think should have caused that rapid decline in the odds for a July cut, because I don't think it was underlyingly strong for the economy. I think the inflation number on wage inflation was positive for the Federal Reserve. So, I mean, I do see the case again for a July cut. I just don't think it's going to happen. And Powell essentially said, if you didn't do tariffs, I would have done a Fed rate cut by now, which I thought was kind of an interesting viewpoint, and I'm sure that did not make President Trump very happy.
Yeah, I agree with that. And again, now we got the June numbers, so July, a month from now, we're talking July numbers. If they still remain strong in the jobs report, inflation, and so forth, I think the tariffs have not been as much of a negative effect as people predicted.
Yeah, and that is one thing. Since there's no meeting in August, I mean, they should have enough data, I think, to make a decision in September.
Yep. Well, let's talk about Apple. Because they produced a new movie with a Brad Pitt, F1. Apple, well, they're obviously known for the iPhone, known for the iPad and the Mac, but top producer of mega hit movies, well, I got to say, not so much. I mean, since 2019, when they started doing this, they have tried to produce big hit movies, and what they had that they thought was going to be big was Killers of the Flower Moon in 2023, 2 years ago. That starred Leonardo DiCaprio and Robert De Niro, but the worldwide box office receipts for the whole movie was only $159 million. That's terrible.
I mean, that's terrible. And Leonardo DiCaprio, I mean, that's a huge name. Robert De Niro, another big. Yeah. I had never heard of this movie until I saw this post. I was like, what is this?
I was reading about this, like, what?
And I did hear about this other movie. I mean, another attempt they had was Napoleon, and that was in 2023, and that was actually Apple's top movie. Never saw it. I heard about it. That one did do slightly better than Killers of the Flower Moon, as it pulled in $221 million in box office receipts. So the big question that you have here is Apple has not had much success in this space. So why did they agree to spend almost $250 million more to produce this F1 movie, which, again, stars Brad Pitt, another big name? Frankly, no one seems to understand. And you talk about the expenses here. Brad Pitt, I was shocked by this. He's making more than Apple, that's for sure, off this. He'll be paid $20 million for this movie and will get a cut of the film's revenue if it's a hit. So I think he's walking away the big winner. The question is, will Apple? We'll have to see.
And one thing I was looking for when I was reading that was, well, how much? They $250 million more. So was somebody else paying $200 million? So they're paying $450 million for this? What are they paying? I couldn't find that number. But no matter what, even with just $250 million, that is more than any movie that they made revenue off of. And revenue is not profit. That's the box office receipt. So, but this one, it does appear to have some chance for success. It was directed by Joe Kosinski, I believe is the way you pronounce his name, and produced by Jerry Bruckheimer. They were successful with Top Gun Maverick, as that movie grossed $1.5 billion in 2022. Last weekend, F1 was a top box office hit with $55.6 million at the box office, but it appears to be struggling with a mass audience, as most viewers were older men like myself who love cars and racing. If you want to see the F1 movie, though, you can get a discount. Use Apple Pay. And Apple's never done that before. So if you go into the box office and you say, here's my Apple Pay, you get some type of discount for doing that. So are you going to go see the movie?
Probably not.
Yeah.
I might see it when it comes out. I generally I don't watch as much TV as I used to. We try and keep TV limited for my daughter.
Well, you got 2 young ones now.
Two young ones, so not much time for TV. So generally my wife and I watch TV together, and I don't know if she'll be interested in watching this one.
Yeah,
maybe with Brad Pitt, I don't know.
I'm going to drag my wife to it. No.
But we'll see. And I mean, you kind of talk about on the other side of the equation, again, back to Apple and profitability. I mean, this is kind of interesting too. Warner Brothers was actually tapped for distributing F1, and they will receive a percentage of box office revenue that increases as ticket sales rise. So again, we talk about Brad Pitt making all this money. Now Warner Brothers is making money. When does Apple make money off this? I just don't quite understand it. And the other concern is Warner Brothers will actually be releasing their potential hit movie Superman. And could that then override the promotion of F1 because they'll then be focusing on that instead? Well, they'll probably make more money as they own the full rights there.
Yeah, one thing I was wondering when I saw that, Superman the movie, is this the 10th one that's come out? I mean, I just seem it's like always, I'll probably watch it because I'm kind of curious, but I think you're right. They'll probably take away from, well, we're going to promote our own movie over F1. But Apple does seem to struggle in this space. It has spending billions of dollars annually, but continues to lose in the development of hit movies. Now, Apple TV Plus only has 27 million subscribers and is known for subscribers canceling their subscription after watching a particular movie or show, saying, I'm done, I watch what I want, we'll cancel it. Now, cancellation rate for Netflix is only 2%. Apple, 6%. So they seem to be failing, and I know Apple has billions of dollars, but they just don't seem to be doing well in the space. I almost wonder if it's like a pet project for, I don't know, Tim Cook or somebody that wants to be in the movies, wants to do movies because they're not making money off of this. It's definitely a loser for them.
No, I'd say it's a huge loser. And, the interesting thing is you said 27 million subscribers. I'm technically subscribed to Apple Plus or Apple TV, whatever it's called. I don't even know. I haven't used it. The reason I'm subscribed to is because T-Mobile gives it to me for free as part of my subscription to T-Mobile. So am I counted as one of the 27 million, even though I'm not necessarily paying for it? That could make those numbers even worse. And I would then say, I mean, I've only ever watched one series on Apple, and that was Ted Lasso. I thought that was a great series.
I always talk about that one.
It was a great one. But that was, I think, produced by, again, Warner Brothers. So Apple just doesn't seem to have success here. And as you said, I don't know why they're doing it. They have the capacity. It's not like Apple's in a terrible spot. They're still bringing in billions of dollars in profits and cash flow. They're fine. It just seems like it's detracting from the actual business, and I don't know why they stay in this space. I understand like Amazon being in the space, let's say, because they have that Prime membership. Where is Apple benefiting? I'm not sure.
Yeah, and I think they do count that free subscription in their 27 million subscribers, and that's well below the other ones, Paramount, Amazon,
Hulu, Disney Plus. Yeah, Apple's definitely, I'd say, bottom of the barrel there in the competition.
Yeah. Let's talk about something to help out investors because everybody always looks for the highest return, highest yield, and sometimes that can burn you. Don't be fooled by these ultra-high income ETFs. And when I wrote this, I wouldn't think I would have to warn people that if you're being offered a yield of 100% or more on a fund, well, the risk has to be extremely high, and there's probably a good chance for loss. However, with that said, this year, 2024 alone, $6.4 billion of new money was put into these high risk, high income ETFs. And the thing with them too is that I assume it's being done by unsuspecting buyers or investors of these funds who really just don't understand how these funds work, which we're going to try to explain a little bit to you here.
Yeah, and this kind of goes to that point you just made of the unsuspecting buyer, because regulatory filings actually do show that at least 95% of these ETFs are held by individual investors or small financial advisors. So it's not big money managers. It's not, these big institutions. It's not pension funds. It's the small guy. And unfortunately, again, it appears they're the ones that will likely get burned once again. And the problem is the way that they generate this high income is by trading an options contract specifically on a single stock. And then it is misleading, I would say, how they come up with these ultra high yields of 100% plus, as they take the ETF's payout from option trading in the most recent month, then multiply it by 12 and divide it by the fund's net asset value. The thing you have to understand is options trading does not stay consistent. It's not like a company when they say, we're going to pay out this dividend rate. That is going to be pretty stable, potentially increase in many cases. options trading is going to be totally variable from month to month. So you could have, I'm going to make numbers just up here essentially. You could have a distribution rate of 100% one month, 70% the next month, 120% the following month. It depends on what that options trading looks like. So it's not a true yield that's going to be consistent.
And it just makes no sense. I mean, you hear the word option. Since I've been doing this 40 years, whenever I heard option, risk. Yeah. Two were together to me. But again, that's why I explain this to you. As an example, I want to give people an example. Go back to November 2022 when a fund called Yield Max TSLA Option Income Strategy ETF, the symbol is TSLY, sold options on Tesla stock and promoted the yield was, at that time, 62.8%. That immediately should have been, stay away from this, there's something wrong here. Unfortunately, the fund has now dropped down to under $9 a share, roughly an 80% loss on this fund. I mean, there's so much proof not to do these, but people want to I've discovered this. This makes a 60% yield. I'll double my money in over 2 years. This is the best thing ever. I'm going to sell that conservative stock and buy this. I mean, people, they want to believe, but the only one winning here is Wall Street and the creator of those ETFs.
Well, and I would say, you might be saying, well, how is it down 80%? If you look at Tesla stock, it was actually up around 70% during that same time period. So how could you have lost? It's again because it's based off the options. It's not based off Tesla stock. And I think it's so misleading because I think the average person's like, wow, Tesla doesn't pay a dividend. Now I can buy Tesla and get this huge dividend. Doesn't work that way. And the other problem that people might have is if they're doing what we call a DRIP or dividend reinvestment program. You're getting the income and then reinvesting it in this asset that is declining massively. I mean, you could be losing your shirt on this. But as you said, it's again the Wall Street, it's the ETF companies that are making the big money here. I don't think the average investor is going to make money off these products long term. I just think they're too complicated for the average person to utilize, frankly.
And there's no safety there. You got the risk of Tesla stock, very volatile stock. You got the risk of, in the fund, one company, no diversification, and then the other risk, options. I mean, why? I don't know why the SEC is even allowing this. And I think we've really gone so far, I guess, to the right, where it's laissez-faire, keep your hands off, investor beware. And you got to beware because a lot of people are going to start losing a lot of money in the future years to come.
And again, I'm not a tax professional. We don't use these products, so I'm not sure how they're even taxed. Generally, options trading is not taxed as dividend interest or dividend tax rates either, which is going to be tax favored at 0, 15, 20% depending on your income. It's going to be taxed as ordinary income. So are these distributions taxed as ordinary income? That could even then make your returns worse because you're maybe losing money on the fund, getting this income, paying taxes on that distribution. It could be a total nightmare that you just get smacked in the face with, 6, 12, 18 months down the road. You're like, wow, I lost 80% and I still have a tax bill? How does that work?
And over $6 billion last year went into these crazy funds. I just don't get it. So that's why we do the newsletter. That's why we do Smart Investing Show and all these things to try and make people smarter investors.
I don't know if we can be more clear on this. Be very careful, please, with these. These are very dangerous.
I'm going to be more clear than that. Don't do it. Okay, please. Let's talk about what you should be doing is looking at individual companies as good investments to hold. And we talk about 3 to 5 years. But let's look at the Goldman Sachs. I was glad we picked this one here. Gosh, time goes by too quick here. But Goldman Sachs and the capital markets, short is only 1.9%. PE ratio still pretty good, 16.8 versus 21. Price of sales 4.4 versus 2.9. That's high. You do want the valuation ratios lower here. Price to book 2 versus 2.1, and no price of cash flow, which is kind of strange. They do have a PEG ratio of 1 versus 2, and that's a positive, showing you're not paying much for the future growth of the company. And wow, earnings per share last year were up 38% versus 29% for the industry. Sales increased for Goldman Sachs by 8.6, also above the industry of 5.6. 5-year earnings per share growth estimate from the analyst, 17.1 versus 15.5, so those all look good. They do pay a small dividend of 1.7%. Maybe that's not really small, maybe mid-size. They use 27% of their earnings to pay that out. The balance sheet, they're a bank, so they don't have a current ratio, but their debt to equity, 2.9. That is high compared to the industry at 2.1. Net profit margin, very good, 27.4 versus 14.5, and return to equity, 11.4 versus 11.9. Free cash flow, I've noticed with banks a little bit different. Free cash flow is a negative $24 billion. The industry is a negative $7.5 billion. I've not figured out why banks seem to have a harder time with free cash flow.
Yeah, and my assumption is just the accounting with them is so different.
That's what I'm thinking.
And that's, again, an assumption, not a fact, but I take that as you want, I guess, with the numbers. But looking at the current price for Goldman Sachs and their ticker symbol GS, it's $723.68. The 52-week range, it's done very well. I mean, the low here, $437.37. The high, $726, actually did hit that in trading on Thursday. Year-to-date, stocks up about 26%, so off to a great start in 2025. I was kind of shocked by this. 5-year return up 249%. It's interesting, the 10-year return up 245%. So, I mean, of that 10-year return, a lot of it's come in the last 5. So, congrats to people maybe that bought it 10 years ago and stayed patient because that 1 5-year period, you did not do that well.
That's true.
And I was going to say, I mean, the reason I wanted to pull Goldman Sachs here was the Fed stress test results came out last week. All banks passed. Goldman appeared to actually be a big winner in terms of the outcome from that stress test. Definitely some favorable results. They actually ended up increasing their dividend as well as part of their capital return program from $3 a share to $4 a share. So a nice 33% increase. That would now mean you get $16 a year essentially in dividends. I'm going to say it's not that exciting, though. From a yield, it's still about 2.2%. So, I mean, it's not bad, but it's not like, oh, wow, you're getting 100% yield.
And I think I missed, did all the banks release that or just?
All the banks did release that, yes. Yeah. So they all passed the stress test. I know like JP Morgan announced like a $50 billion buyback. They increased their dividend. Bank of America, Wells Fargo, Citigroup, they all increased dividends. So, if you're holding those banks, expect to see a little bit nicer of a yield coming in each quarter.
I know we're expecting big news from Wells Fargo because they had the most to gain. I don't know if you heard from Wells Fargo.
They did increase their dividend pretty handsomely. I forget the exact dividend increase percent that they came out with, but I know it was a nice increase for shareholders there.
I must have slept in that morning it came out.
I think it was Tuesday evening, if I'm not mistaken. So, but target sell price, I got to get that real quick on Goldman Sachs. Estimated earnings per share, December 2026, $49.84, gives us a target sell price at $827.34. That would place it in the hold category as it does trade around 14.5 times future earnings. So I wouldn't be a buyer here. I was going to say I was kind of interested because there is a lot of excitement around capital markets, IPOs. Yeah. I think that's going to be a benefit to Goldman, but it seems like he may have missed the party a little bit, and it has moved up to a little bit more of a premium valuation.
Alrighty, all this information does come from our newsletter, the Smart Investing newsletter. Other ones there where job openings remain strong. Don't be fooled by high ultra income funds. We talked about that. Well, the website, smartinvesting2000.com. That's smartinvesting2000.com. We'll be right back after this quick break. Alrighty, welcome back to Smart Investing Show. And remember, July 25th at 3 o'clock, we're going to do the live taping of the Smart Investing Show. Admission is free. It's going to be here at our new studio that we have in our office here. And we're going to do the regular show. And then at the end, you're going to be able to ask us questions about the economy, stocks, financial planning, investing. We'll actually do some of the stocks as well. If you want to have a stock you want to do, we'll do the numbers for them as well. So we think it's going to be a great thing. So it'll be, again, July 25th at 3 o'clock. It's free. It's going to be 2 hours from the show and the questions and so forth. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And look for the podcast tab. We made it pretty easy, I think, for people to sign up there. So we'll see. But hope to see you there. And seating is very limited, so we don't have a big studio, but we want to kind of open up to people so they can ask us questions and so forth. So speaking of that, let's talk about financial planning. Harrison Johnson, CFP, has joined us here. Pension lump sum versus monthly income. I think a lot of people wrestle with this, don't they?
A lot of people do. And I mean, pensions aren't as prevalent as they used to be, but there's still a lot of people that, at least I encounter, that have pensions, whether they work for the government, work for a hospital, work for a defense contractor, work for a school. So one of the things that you have to decide, and not every pension allows this, but a lot of them do allow you to take a lump sum option as opposed to getting the guaranteed monthly income for your life or, you and your spouse's life. So, it's a question that a lot of people do have to worry about. And one of the main things to look at is, if you're taking that lump sum, you're giving up the guaranteed monthly income, but now you have that money and you can do whatever you want with it. You can roll it into an IRA. That's a tax deferred rollover, so no initial tax on that. And then you can invest it how you want, create income how you want, take distributions how you want, convert it if you want. So there's a lot more flexibility, with that.
And one thing I always wonder, there's never 100% all the time you should do this.
No, definitely not.
So this is something, again, you got to sit down with somebody that knows your whole financial situation, knows your taxes, has a financial plan for you. Say, for your situation, this is what's best. And you're only going to get that with a fee-based financial planner.
And there's a lot of things to look at that you mentioned. And the first thing that I look at is, okay, if you take the lump sum and give up the monthly income, if you invest that lump sum money, what return do you need to earn on that to generate the same amount of income that the pension would? And when you have a pension, the income options, you can do it for a single life, joint life with you and a spouse. You can do period certain. You can do with contingencies. So there's a lot of different options inside of the monthly income. But the main one that I look at is with a joint life benefit for you and a spouse. The reason I like to look at that is because if you're also getting Social Security, when the first spouse passes, the lower Social Security gets reduced, so you don't also want to have a reduction in pension income. So looking at that joint income on the pension side, and then if you take the lump sum, what do you have to return on that to create that same joint pension income? And again, the thing about with pensions is they stop when you die. So, in many cases, the return that you need on the lump sum isn't as much as you might think. When I look at it, you might need 3 to 4% on the lower end to 6 to 7% on the upper end on that lump sum to recreate it. And in many cases, if you invest your money wisely, you can do better than that and then get all the other flexibility that comes along with it.
And real quick, what about the longevity? I mean, if you have your parents, say you're 50 years old, your parents both died at 70, you don't have longevity. Does that come into play?
It absolutely does. No, that's a good point, because when you take the lump sum, it's called an internal rate of return calculation. So you do the calculation, and what I do is I say, okay, well, if you live to be 75, this is the return that you need. If you live to be 85, this is the return you would need. If you live to be 95, and the longer out you go, the higher return you would need on the lump sum, because it has to pay income for a longer period of time. So it absolutely does make sense. And we can look at longevity in family, health history, things like that. And in some cases we might say, well, you've got parents that lived into their 90s. You're really healthy. You might live into your 90s as well. If you take this lump sum and you also live into your 90s, you would need a return of 10% to pay that out. At that level, people might be more comfortable taking the guaranteed pension option as opposed to the lump sum. So absolutely it does.
Yeah, I was going to say too, I don't know if you spoke to this point already. I was kind of looking at something else, so I missed part of the conversation.
Appreciate it.
But I know you talk about flexibility. I mean, have you looked at anything in terms of tax rates? Because obviously if you take the lump sum, you're not necessarily distributing that same amount. That flexibility kicks in where you can then maybe look at a Roth conversion strategy to ultimately lower the tax burden of that as well.
So the thing to keep in mind is when you take a lump sum from a pension, that's also a future income source. Mm-hmm. You see the monthly income from the pension side, and that's obviously an income source. But giving up that doesn't mean you're not going to have income. It just means it's coming from the lump sum. And with tax rates changing, that happens all of the time, especially throughout somebody's entire retirement. Their income is likely going to change with the onset of other required distributions that they have, with starting Social Security with one spouse passing, and then filing as a single person for their surviving spouse. So there's a lot of different changes that will happen to income level and tax rates throughout retirement. So having the lump sum option and being able to choose, okay, well, I want to distribute more during this time when my tax rate's a little bit lower. I want to convert some of it to Roth. That way, later on I won't get killed in taxes, and then I can leave some of that money to my kids as well, as opposed to just having, nope, you're going to get $5,000 a month for the rest of your month, for the rest of your life, and there's no changing it, no matter what taxes do or anything else.
Yeah, I never understand, I guess, if we can, because we have an income portfolio, we pay out a 6% distribution rate, which seems to be almost pretty much in line with a lot of these joint life annuities.
A lot of them are, yeah, especially when you look at the joint one as opposed to like the single one.
Yeah, and I'm always like, why would you take that if we can replicate the income and still keep the principal
Preserve
around?
The principal, yeah. So a lot of times I do gravitate to the lump sum, not always. Some pensions don't allow it. Sometimes, like I find with teachers, a part of the CalPERS programs, you can take, it's not even called a lump sum, it's called a refund of your contributions and then the earnings from that. But in that case, the pension, the monthly income, the guaranteed income is almost always the better thing to do, especially if you had a long career. So sometimes it does make sense to take the guaranteed pension, but a lot of times, like you said, Chase, you can take the lump sum, invest the money, create a similar or higher level of income, and preserve the principal that comes with all the flexibility and freedom that goes along with that.
Anything that worries me or would really bother me, I think I'd come back from the grave. You have a $250,000 pension plan. You say, okay, I'm going to keep it with the company because I have longevity in my family. And then for some reason, 2 years later after retirement, you get hit by a bus, you die.
That's another thing, too.
All that money goes back to the insurance company.
Yeah, that's another thing, too. So just because you have longevity, and obviously that's something that's terrible, but it does happen. I mean, you see cases where someone is really healthy, and then something happens and they pass away unexpectedly too early. And in that case, you have a $500,000 lump sum, or you elect to get $3,000 a month, and then you die 2 years later, and you got, less than $80,000. So, over $100,000 or over $400,000 is now, left out. So,
yeah, I mean, one thing we do at Wilsey Asset Management is we really try to grow generational wealth for people, to grow that family wealth, and that would destroy it if you lost all that money. You just went back to the insurance company.
We never want to plan to run out of money at any point. So we never know how long you're going to live. So we always want to plan to always have money, always have income, and preserve the principal, and then, you get flexibility with that. Can access it more if you need it later, pass it on to heirs. But taking the pension guaranteed income, a lot of people like the pensions guaranteed income, but people also like money. So, taking the lump sum, a lot of times it objectively does work out to be better.
And that's why they need to sit down with a fee-based financial planner that's unbiased to give them all the different options, and then they can decide after they're educated.
Absolutely. Here's the numbers. This is what you're agreeing to, as opposed to, well, do I like the lump sum? Do I like... A lot of times, too, the pension amounts are not inflation adjusted. So, you're stuck with that, and you can't withdraw more later on. So,
yeah. Well, Harrison, thank you very much. We appreciate it, and we'll talk to you more next week.
Thanks, guys. Appreciate it.
All righty. Again, it's Harrison Johnson, CFP financial planner at Wilsey Asset Management. He's a fee-based planner. If you want a free consultation with him, you can just do that by calling him at the office, 858-224-0004. Again, 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com, and you can... send me an email and set up a time with them. First consultation is free to help you out. All right, let's move on to our next company here we're looking at in the equity market, Robinhood Markets. This company just always bothered me. I know they're doing well on the stock side, but we're going to talk about today, right?
Yeah, I don't know if you want to talk about what I want to talk about before we do the numbers, because, this just blows me away. And I'm going to do it. We're going to talk about it first.
You got the flow.
Yeah, we got the flow going. So, looking at Robinhood, I was shocked. They came out and said... on Monday, as part of a broader product showcase focused on tokenized equities, that they were essentially going to offer these tokens for OpenAI and SpaceX. But the
Sounds good.
Sounds good. But they can't do it here in the U.S. It's only for foreign countries. But then this is where it gets interesting. OpenAI came out and said these OpenAI tokens are not OpenAI equity. We did not partner with Robinhood. We're not involved in this and do not endorse it. So if OpenAI has nothing to do with this, what the heck are these tokens? Are they nothing? Like, do they just have an OpenAI name to them? It just blows me away that these are even allowed. It just is so deceitful in my mind.
And I've seen the CEOs from Robinhood and stuff, and they're just very salesy. Yeah. And I think that's what they did. Like, hey, this is a great idea. Let's do it. They never bother to check with anybody to see if it makes any sense, or, as you said,
what is it?
What is it? Yeah, it's like, but it makes their stock go up, and that's why I want to kind of look at it, because I know, and this is supposed to be the younger person's stock, but I am so worried when I hear stuff like this that this is just a wall that is eventually going to collapse.
Well, I think they now have betting markets too, where you can bet on different things. And again, these tokens, they just drive me crazy because again, anybody can create a cryptocurrency. So is it essentially they're creating cryptocurrencies that have an OpenAI name to them? Because again, stock is ownership in that company. This is no ownership in OpenAI. OpenAI has nothing to do with it. So ultimately, what the heck is it? We don't know. There is no correlation to OpenAI. So how is that thing going to trade? Not based off the fundamentals. It is, again, I think just a betting market is all it is on OpenAI's name.
It reminds me back during the tech boom when I was working, and people say, oh, fundamentals, they don't mean anything anymore. That's kind of what we're seeing right now, a lot of things like this. Don't worry about the fundamentals. Who cares?
Well, it's almost funny, too. I looked at it and you're like, oh, you don't get it. And you're right. I don't get this at all. Like, what is this? I don't know.
Well, let's share the numbers on the company with people, and they can make their own decision. But the company, again, is Robinhood Markets. Hood, H-O-O-D is their symbol, and their capital markets, like Goldman Sachs was. About 4% short on the float side. P/E ratio, great start. 53.8 versus 20.7, so very expensive. Price of sales, oh my gosh, 26.3 versus 2.9. Price to book value, 10.5 versus 2.1. That sounds better, but that's still 5 times the industry average. And then price to cash flow, 77 versus 50. The PEG ratio, I will say, it does look good, 0.9 versus 2. Now, wow, their earnings over the last year, 464% increase versus 29.3 for the industry. Congratulations there. Sales are up 45.7 versus 5.6. And I guess if you create all these strange things, your sales will do pretty well. They have a 5-year earnings per share growth rate estimate from the analysts of 75% versus 15% for the industry. They do not pay a dividend. Look at the balance sheet. They got a current ratio of 1.4 versus 1 for the industry. That's a positive. Debt to equity, not too bad, 1.1 versus 2.1. They have a net profit margin. Wow, 48.8 versus 14.5. Return on equity is 20 versus 11.9. Free cash flow looks pretty good here. It's $1 billion versus a negative $7.5 billion for the industry. So the numbers look okay, except for what you're paying for these numbers.
Yeah, and looking here at the current price for Robinhood, again, their ticker symbol is Hood, H-O-O-D. It's $94.40. I mean, the stock has done tremendously over the last year. The low was $13.98. The high was $100.88. The 1-year return is 336.2%. So again, done very, very well. The interesting thing, though, is there was a lot of hype again in the market back in 2021, and I knew Robinhood was high. I didn't realize it was $85.06. So from that last high that was hit in 2021, you're really not up that much.
Oh, so it was 85 before. It went all the way down to, I think, 10, 20 or something. But the 3-year return, I'd say, is 1,048%, but that was probably after that high was reached of 85, I guess is what you're saying.
Yeah, so it hit 85, and then it looks like it fell, as low as $6, $7 a share.
Wow.
So, I mean, it got pummeled now. The question is it going to get pummeled again? I mean, potentially. And I say that because we talked about the high valuations. We look out even to December 2026, estimated earnings per share here, $1.49. I mean, it's again, laughable. Target sell price, $24.73. Forward PE is about 66 times those future earnings. And the thing that I find very interesting, you talk about the high profit margins, you talk about the high earnings per share growth over the last few years. I'm wondering if there's something on the accounting standards, because in 2025, earnings are estimated to actually fall about 18%.
Right.
So they had good profits over the last 12 months, but the next 12 months to have a decline on this growing company is very interesting. And then essentially in 2026, they're estimated to kind of recoup that with a 16% earnings growth. And I point that out because then you have a 2-year earnings growth that is essentially flat to slightly down, but a valuation over 65 times those earnings. Why are you paying that much for a company that's maybe not growing?
Well, and Jason, this is why we tell people, this is the start of the research. We give you the numbers. That 464% growth on earnings sounded great. The 45% growth on sales sounded great. But you got to look at the numbers, because they can have very, very low numbers that you're growing off of. Could have been, the earnings could have been 4 cents. Well, yeah, you're going to have a big growth up to, 25 cents or something. So that's why we give you these numbers. We say, wow, those numbers. But it's your responsibility as an investor, which we do, is say, well, what are those numbers? Because it may look big, but it's off of a small number. And they could have big write-offs. They could have had a sale of a building. I mean, who knows? That's why you got to look deeper into these things when I give you these numbers.
Yeah, I think it is so important. And I mean, this, like their platform, is a gamble, ultimately, at the end of the day.
Yeah. And again, I think they're great salespeople.
Yeah.
But I'm concerned that people say stocks are so risky. Well, it's risky when you do something silly like this, because it's all salesy.
Well, and it worries me as well because, I mean, I've talked about this before, but we talk about how the stock market's expensive. We talked, I think, recently about how SPACs have kind of come back a little bit. You talk about how the Robin Hoods of the world have done well, how the Palantirs of the world have done well. It scares me. We talked about the scams last week. I mean, there's so many things out there right now that are so speculative like this that it is, again, kind of starting to build this house of cards that could collapse very, very quickly. And all of a sudden, people will be shocked, I think, with how quickly things can turn and go negative. Again, we saw it in 2022. Things went super negative, super quick. Now they rebounded very quickly, but that doesn't always happen.
You know, and Chase, on Thursday, we had that sale of a company that we've held for 5 years, did extremely well, up like 600% or something. And I was so relieved that it hit the target sell price and we get out of it, because I am getting kind of nervous. And the other thing we look at too is that when we're investing on our whole buy list, we got 2 companies that we can buy for that.
That's 2 or 3 right now.
2 or 3. I mean, there's just not much out there. Everything is so expensive, and I've done this for 40 years. It seems whenever I get to that point in the near future, things fall apart. So too good to be true. Sometimes don't last. So we'll see. But and this is summertime. Summertime usually doesn't work so well on July and August. So we'll see on that.
Actually, there hasn't been a negative July, I guess, since like 2014. So July's actually been a pretty good month for the last like 10 years, I saw. But I think it's August, September, October are a little bit challenging.
And that does change. I mean, obviously, it's not bad.
And I'm very careful playing that game because this could be the first negative July in 10 years.
And look at the last big pullback we had prior to this little blip we had in March or April was 2022. So it's just things keep getting better and better, and you keep stacking a brick on top of brick on top of brick. Eventually, it kind of collapses. And there's so many things in the market too expensive. You got to be very careful investing here. So let's move on to another company here, a healthcare company, CNC. Centene, is that the way you pronounce it?
That's the way I'm going to pronounce it.
Okay, Centene, symbol CNC. CNC, yeah. Healthcare plans is their industry. Only 2.1% is short on the float. 99.9% institutional owned. Now, great start here. And again, remember, these are numbers. You got to look a little bit deeper. But great start. PE ratio 4.9 versus 13.7. Price to sales 0.1 versus 0.4. Price to book value is 0.6 versus 2.0, and price to cash flow 8.1 versus 10.8. Gotta love the PEG ratio, which is price earnings divided by growth going forward, 0.3 versus 1.7. So the valuations on this look very, very good. On the growth side, wow, earnings over the last year were up 27.7% versus 23.5. Sales did climb by 7.3% over the last year. That is also above the industry at 5.9. 5-year earnings per share growth estimate is 16.5 versus 14.4. That's pretty good growth going forward. I'm surprised. Healthcare company doesn't pay a dividend.
That's interesting.
That's kind of shocking to me. Balance sheet, current ratio 1.1 versus 0.6. That's a positive. Debt to equity 0.7 versus 0.8. Another positive there. We do see a net profit margin of 2. Now, that is below the industry at 2.8. Return on equity is okay at 12.4 versus 18.7. Free cash flow could be a problem here. It's a $1.5 billion. The industry is at $13.9 billion. So maybe there's some issue with their free cash flow because we like a lot of cash flow coming into the business. Chase, what do you got?
Yeah, so interesting situation here with Centene. They actually fell by about 40% this past week in one single day. I mean, wow. It was a massive decline, obviously. And the problem is they actually withdrew the 2025 guidance. And the reason for that is, I guess, from the data, which accounts for 22 of Centene's 29 marketplace states. So, frankly, I've never heard of Centene. I don't think it's in California. Maybe it's a smaller location in California, but I know it's not an option we have in our health insurance plans. But, again, it's only in 29 states. So that would worry me a little bit because, if it's maybe concentrated in one region, that could cause concerns. But the thing that you looked at with the 22 out of 29 marketplace states that they had, they expect now a shortfall that they said will lower its adjusted earnings by about $2.75 per share. Higher medical costs and Centene's Medicaid business have continued to weigh on the company, is what they said. So, I mean, that's a big concern. Obviously, to have a stock fall by, nearly 40% in a single day, I mean, that's rough, to say the least. Going forward, though, a little bit disappointed by this because, the PE was quite low over the trailing 12 months. I don't have any analysts. Do you have analysts?
Yeah, I've got 18 with Stocker over here, and they say the earnings estimate for December 2026, $7.91. And I was looking for a big fall over the last 90 days, it's actually up from 788 to 791.
I mean, that would give you a target sell price of $131.31. So, I mean, compared to $33.31, which is, again, the current price, I mean, that looks attractive and give you an idea of how big that fall was. I mean, the 52-week range, now $33.30 is the low, the high $80.59. So, I mean, it's very attractive from a valuation standpoint. But, gosh, there's some question marks. I mean,
well, yeah, because you said that they did some 22 markets and they were cutting the earnings dramatically. I don't see that.
Yeah, and I mean, maybe that'll kind of happen here over the next couple weeks because what did we say again? It was 791. I mean, you reduce that by 275, let's say. I mean, that still is quite attractive from a valuation standpoint. I mean, that still give you $5.16 in earnings. I mean, that would still give you a target sell price of $85.66. I mean, the valuations on this still look intriguing. I think there's a lot more to uncover here in looking at the story. And also, too, I mean, I know there's been some changes to the tax bill that, has passed the House, passed the Senate, and I believe President Trump will be signing it here shortly. Just to be clear, we're filming the show on July 3rd, so he may have signed it by the time you hear this. But this company, it looks like they have business in Medicaid, Medicare, commercial, and other 4 segments. I wonder if they're more prevalent in Medicaid and Medicare than a lot of the other insurers, and that could weigh on them if there are some concerns over that Medicaid business.
I mean, we do have a healthcare insurer in our portfolio already, so we wouldn't want another one. But I would tell the smart investor here that this is worth looking at, but you've got to understand what's going on because this could be a very good value growth company, do very well the next few years with it. Disappointed they don't pay a dividend on top of that, but there could be something here. But as always, I mean, that's what we tell people. Before you invest in a company, 10, 15, 20 hours of research, you really got to understand what's going on there. But I think this one's worth the research.
I agree. I mean, there's potentially something there. Sometimes, though, stock goes down 40% for a reason, and that might spook you, but also could be the bottom and can be a good opportunity. So
yeah, exactly. Could be the buying time. So, all right, well, let's take a look at Columbia Sportswear Company, symbol COM, or COLM. They're in the industry of... Oh, wait, it didn't click on here. What happened? I thought I'd change it, and I guess let me click on the right button here. That would help. Let's see. There we go. Apparel manufacturing. That's the one. All right. Oh, my gosh. Chase short is 13.6%. That's not very good. Institutional ownership, 56.6%. That is low. You do have a good PE ratio, though, on Columbia Sportswear, 16.6 versus 21.4. Price of sales, 1.1. That's the same as the industry. Price of book value is 2 versus 2.7. And then price of cash flow, 10.4 with a PEG ratio of 1.0. Happy with that. Now, looking at the growth on the earnings over the last year, not very good. 3.8% versus 23% for the industry. Sales were down 0.3%, but the industry is down 8.9%. Analysts on the 5-year, they expect this to change because they say a 5-year earnings per share growth estimate is 21.9%, while the industry is a negative 3.6%. So something about the sportswear, Columbia Sportswear, things may be looking bright in the future here. I do see they pay a decent dividend, 1.9%, usually 31% of their earnings to pay that out. Taking a look at the balance sheet, current ratio, very good, 3.1 versus 2.0, so they got a lot of liquidity there. Not much debt, 0.3 versus 2.2, that's a big positive. Intangible assets are low, 3.9 versus 14.1. Net profit margin, 6.6 versus 4.5. Return on equity, 13.1. And not quite as good as the industry at 20.8. And free cash flow, $292 million versus $716 million for the industry. So I'm kind of liking what I'm seeing here. But again, well, let's see what you got.
Yeah, and I was going to say as well, I mean, the reason I want to look at this was because the trade deal with Vietnam. And I was kind of blown away by this, but Vietnam's exports to the U.S. reportedly comprised 30% of its GDP last year. So they really needed to make sure they made a deal with the U.S., and I think it's maybe why it wasn't as favorable as some may have thought. But it does look like the tariff rate on Vietnamese imports will now be 20%. And then on goods that are actually originated from another country, they did this because sometimes China will send it through Vietnam and then to the U.S. is going to be about 40%. There's some confusion if that's tacked on top of the 10% baseline rate. I only saw one article that said that, which would then make it 20 and essentially 50. But the other articles I read didn't say anything about that. But the point being is, these are now going to be tariff rates that these companies are going to have to deal with. It is better than the 46% tariff that was initially planned, but it is still a substantial cost of doing business there. And Columbia Sportswear has about 48% exposure to Vietnam, so they have a lot of their supply chain there. So definitely some considerations you want to work through, and these earnings estimates might be changing over time, over the next few weeks as they kind of work through the deal and what impacts will have on this company. But right now, it looks intriguing. And I say that because the current price, $63.83. You go out here now to December 2028. I don't know why. I think my system's a little bit off today. I think this is supposed to be 2026. I get $5.15. What do you have as your estimated earnings?
I just going to that right now. Let me see what it says here for December 2026, $2.55.
Well, if we go off 515, your target sells 85.49, so that looks good. Based off yours, it is overpriced, and I would not buy it. So a lot of confusion. My system's a little glitchy, it appears, today.
Yeah, well, could be happening. All right, well, thank you for listening to the Smart Investing Show. It is for informational purposes only. It should not be used as investment advice. If you'd like a free consultation with myself, Brent Wilsey, or Chase Wilsey, give us a call at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Great information there. Sign up for the website. Sign up for the live taping at the podcast tab for July 25th at 3 o'clock. Have a great day. We'll talk with you soon.